and welcome back to the Financial Strategy Revision for November 2014. Once again, I am Tarindra Gunratna and I will be taking you all through some of the key areas of the syllabus today and then wrapping up with a discussion of some of the key examination techniques and how to approach the paper. So, quick summary of what we discussed about the main areas in financial strategy. We said there is investment decision, dividend decision and financing decision. We discussed about dividend policies. We discussed about performance measurement in financial strategy. We then went on to look at how to fund a company's assets, short-term finance as well as long-term finance, and then we wrapped up by looking at cost of capital and how you can factor in your long-term financing to generate a weighted average cost of capital. Today what we will be starting off on is capital structure and what kind of capital structure an organization can have. Now, important to note that an organization's finance department normally has two major areas. One is called financial control, one is called treasury. Financial control is the area that looks at the investment decision. Remember, we said in financial strategy there is investment, financing and dividend. Investment decision will be focused on by the financial control area. The dividend decision, or rather the financing decision, will be focused on by an area called treasury. And it is the treasury operations of a company that will focus on the capital structure of the company. How do we fund our capital? How much equity, how much debt, how much preference shares? That is dealt by treasury, and that is represented in this slide. Now, what are the functions of treasury? Pretty much remember it as a story. Treasury has four major functions. Number one is something called banking. What do you mean by banking? Treasurers and treasury department people are the people who maintain day-to-day relationships with the bank. They are the people who will go for lunch with a bank manager. They are the people who will continuously call a bank manager or a bank employee and ask them what's going on in the interest rates at the moment, and they will maintain that cordial relationship with the bank. That's the banking function of treasury. After maintaining this cordial relationship, then when the company requires funds, the treasurer will use this relationship with the bank to generate funds for the company in terms of long-term funding. That is called the funding management aspect of treasury. Then sometimes the company might need short-term funds, short-term financing. Again, the treasurer will use his relationship with the bank to generate short-term funds for the company. That's called the liquidity management perspective. And finally, if your funds are generated in a foreign currency, the treasurer will manage the foreign currency risk, and that's called the currency management aspect of treasury. Now, in a major investment decision, your financial control arm will look at what projects to invest in. Your financial control arm will do the investment appraisal. It's the treasury that will decide on the financing. How are we going to fund this investment? And that is a critical role of the treasury department. Now, if your company has a centralized treasury, it makes life easy in a number of ways. Number one, it allows you to manage your cash and your financial resources centrally. Number two, it allows you higher bargaining power with banks. Why? All your subsidiaries treasury is in one location. That treasury manages so much funds that it can negotiate with banks for good terms. So, in addition to that, there are so many other major advantages that a centralized treasury department has. Now that we've understood who is mainly responsible in an organization for capital structure, let's look at some theories with regard to capital structure. One theory is something called the traditional theory of capital structure. And the traditional theory is very easy. What the traditional theory says is, gearing and the amount of gearing a company has a twofold impact on the organization. Number one, gearing introduces debt. Debt is the cheapest source of finance. Why? Because debt has the lowest risk attached to it compared to equity, so debt holders can demand a lower interest rate or a lower return. Because debt is a cheaper source of finance, the more gearing you introduce into the company, the lower your weighted average cost of capital goes. Why? You are introducing cheap sources of funding. On the other side, the more debt you introduce into the company, your company's financial risk expands. And the reason for that is, when gearing goes up, the risk to the equity holder goes up. right? The risk of bankruptcy goes up. As a result, your cost of equity increases. That has a upward impact on WACC. So there's a downward impact due to higher, cheaper source of finance. There's an upward impact due to the higher cost of equity. And it's which of these two forces are more dominant that's going to result in your WACC falling or rising. So according to your traditional theory, initially as you introduce more and more debt, your WACC will fall. And the reason for that is debt is cheaper source, therefore the more cheaper source of funding you infuse into the company, your WACC is going to fall. But after a point of time, your cost of equity has risen so much that the cost of equity increase is more than that cheaper debt that you are infusing. And as a result, now your WACC starts to rise again. So with regard to capital structure, traditional theory is very important to remember. Two other important theories to remember is number one, Modigliani and Miller theory without tax. According to this theory, the amount of debt a company has should have no impact on that company's value. Why? A company's value should only be based on the company's future cash flow. So if you have two companies in the same industry that have the same kind of prospects, then these two companies should be valued equally. One company might be 100% debt funded, other company might be 100% equity funded, but that is not relevant. At the end of the day, company has same prospects, it should have the same value. So according to Modigliani and Miller theory without tax, the funding mechanism of a company should have no impact on the overall value of the firm. But a couple of years later, Modigliani and Miller themselves came up with a revised theory called the MM theory with tax. And there they said, look, we made a mistake earlier, right? We said that funding method doesn't really impact the capital structure. But we made a mistake because debt has one major advantage that equity doesn't have. What is that? Debt is interest payment. Interest is a tax deductible expense. Equity has dividends. Dividends are not tax deductible. So the more debt you have, the more interest you pay. The more interest you pay, the more tax benefit you get. So according to the Modigliani and Miller theory with tax, more and more that you fund your company using debt, the more and more your company gets tax benefit. More and more company gets tax benefit, more and more the organization value rises. Okay. Now let's look at the next major area, which is investment appraisal. Now, with regard to investment appraisal, I'm going to club this into three areas. Number one is basic investment appraisal. In terms of basic investment appraisal, you know some of the main areas. You've dealt with payback, discounted payback, accounting rate of return, internal rate of return. You have learnt these areas. You all are absolute experts by now. One new area that was introduced in the financial strategy syllabus was modified internal rate of return, which is also very straightforward. You take all the cash inflows into the final year, you take all the cash outflows into the first year or year zero, then you check the compound average growth rate for your cash outflows to grow into your cash inflows by the end of the investment's time horizon. So modified internal rate of return is straightforward as well. One other factor to remember is this factoring inflation into your project appraisal. So when you're doing an NPV, remember, if you're factoring inflation into the cash flow, you have to discount at the nominal cost of capital. If you're not factoring inflation into the cash flow, you have to discount at the real cost of capital. Now, if we look at advanced investment appraisal for a second. Now basic investment appraisal is very straightforward. We've done it before. We are experts. If you look at advanced investment appraisal, one major area is capital rationing. Now what is capital rationing? Sometimes an organization has so many investment opportunities available, but unfortunately it can't do all those it can't make use of all those investment opportunities. And there's a reason for that. Maybe banks are not willing to provide you money. Maybe shareholders are not willing to give you more cash. Now that's a capital rationing situation. I have 10 different projects that I want to invest in. I have money for only one project. So how do I prioritize the 10 projects, pick what project I'm going to invest in? Now, when you have to make a capital rationing decision, there are a couple of questions you have to ask yourself. Number one, is this project mutually exclusive? In other words, if I have project A, B and C, if I do project A, then can I not do project B and C? So if you do A, you can't do B and C. That's a mutually exclusive project. If you have a mutually exclusive project, your decision is very straightforward. You decide on NPV. Highest NPV generating project is the project you will invest in. On the other side, your projects can be non-mutually exclusive as well. In other words, I can do A, I can do B, I can do C. So very straightforward. If your projects are non-mutually exclusive, you then have to ask yourself, are these projects divisible or non-divisible? What do you mean by divisibility? You don't have to invest 100% in the project. You can invest 10% in the project, 30% in the project, 75% in the project. Those are divisible projects. What is a non-divisible project? You either invest 0%, in other words don't invest, or you invest 100%. You can't invest 30%, 40%, either 100% or 0%. So if your project is a divisible project, how you look at capital rationing is using profitability index. If it's a non-divisible project, how you look at capital rationing is using the combinations approach. And a few other areas to look at is things like adjusted present value. Adjusted present value is an important concept, which has not been tested frequently, but it's possible that the examiner will test you at the exam. Another area is on real options analysis, on the strategic investment option, timing option, abandonment option. That's something you'll have to read up on. And also on factoring in risk into investment appraisal. So remember, how can you factor in risk to an investment appraisal? Couple of methods. You can do a sensitivity analysis. You can have a risk adjusted cost of capital. Normally I evaluate projects using 10%. Because this investment is high risk, I'll evaluate using 12%. And you can do things like scenario analysis and contingency analysis. So there are different approaches you can factor in risk into investment appraisal as well. Now, final area of investment appraisal is foreign investment appraisal. In terms of foreign investment appraisal, there are two methods you can appraise a foreign investment. Two methods you can get the same answer. Number one is by converting the foreign cash flows into your domestic cash flows and then discounting it at your domestic cost of capital. The other approach is converting your discounting your foreign cash flows at your foreign cost of capital and then converting the final result at the spot rate. So let's look at these two methods briefly. Converting cash flows. What you need to do is very straightforward. Remember, in a foreign investment appraisal, the only difference to a normal investment appraisal is it deals with foreign cash flow. So there is an exchange rate situation you have to take into perspective. Now, in terms of exchange rates, normally examiner will give you the spot rate. He says spot rate is €1 equals $1.4. Now, you may have to calculate forward rates for future years. Now, how do you calculate forward rates? You can use interest rate parity or purchasing power parity. But remember, out of the two, interest rate parity is superior. So use it whenever possible. Now, once you calculate your forward rates and you have your spot rate, what you have to do now is, under this converting cash flows approach, you convert your foreign cash flows into your domestic cash flows by converting at the exchange rate applicable. Once you have your domestic cash flows, now it's like a normal domestic investment appraisal. You take your domestic cash flows, you discount at your domestic cost of capital, you generate your NPV, done and dusted. However, if you look at the converting the cost of capital approach, in this, first thing you do is you convert domestic cost of capital into a foreign cost of capital, first thing. Then you discount the foreign cash flows at the foreign cost of capital and you arrive at the foreign currency NPV. Once you have the foreign currency NPV, you convert this at the spot rate to the local currency NPV. And if you do it right, both methods should give you the same answer. Another nitty-gritty to remember with regard to foreign investment appraisal is how to deal with double taxation. And remember, countries have double taxation treaties. So normally, if you are taxed in one country, you are provided a tax exemption up to that amount in the other country. So this is a factor to think about in terms of foreign investment appraisal as well. So what did we look at up to now? right now in this session we have looked at capital structure and how an organization can fund its operations using debt or equity. We've talked about the importance of treasury in determining an organization's capital structure, and finally we've looked at investment appraisal. We've looked at basic investment appraisal, advanced investment appraisal, and appraising foreign investments as well. We'll take a break, and when we come back we'll be focusing on the last area of the syllabus, which is mergers and acquisitions and valuation. Hello and welcome back. So we've covered 7 of the 9 major areas in financial strategy. We now have mergers and acquisitions and valuation left. So let's start off with a look at mergers and acquisitions. Now, just a couple of examples for you all about recent mergers and acquisitions. Facebook's acquisition of WhatsApp is a classic example of a massive acquisition that happened, right? Facebook decided to acquire WhatsApp for $19 billion. Now, couple of points important for you in the syllabus in this example is that this $19 billion was structured as $4 billion in cash, $15 billion in shares. So it was predominantly a share-based acquisition, and we'll come to share-based acquisitions in a second. Another important point to note is the second bullet point over there, that the shares in Facebook dropped 5% after this announcement was made, and this is something we see a lot. As soon as a company announces that it's going to acquire another company, that acquirer, not the acquiree, acquirer's share price falls. And that's a very interesting point, and let's look at why that happens as well. So one interesting acquisition. Another interesting acquisition recently was the acquisition of Nokia's handheld devices by Microsoft. Now Microsoft decided to pay $7.2 billion to acquire Nokia, but unlike Facebook, Microsoft did a cash-based acquisition. Microsoft has a huge amount of cash reserves. It decided to do a 100% cash-based acquisition. Now just look at that second bullet point. Just like Facebook's example, immediately after Microsoft announced that it was going to acquire Nokia, Microsoft's share price dropped by 5% at the end of the day's trading, right? Which is a big drop for a company of Microsoft's size. The shares in Nokia climbed 34%. So why does this happen? Let's have a look at this. Now, in terms of mergers and acquisitions, one major area you have to remember is why do companies do mergers and acquisitions, right? Mainly, companies do M&As for economies of scale. In other words, you are a big company. By acquiring another big company, you expand your operations, and by expanding your operations, you generate economies of scale. Your unit cost goes down, your profits expand. Another reason a company acquires another company is to take advantage of synergies, right? For example, that 1 + 1 = 3 concept. Now, my company has certain important resources. The other company also has certain important resources. If I combine the two companies together, the value of these two companies is much more than when the companies were standing as individual entities. Now, there are few other reasons that companies acquire other companies as well. One is to get rid of competition, and that's a reasonable reason as well. But there are 2 reasons that people normally quote as reasons for acquisitions, which I disagree on. I don't think those are valid reasons for acquisitions, neither does your examiner. Number 1 is for diversification. People say when you acquire another company, you can diversify your risk. Well, if you really wanted to diversify your risk, you don't have to go and acquire another company. If you have so much cash available and you have nothing else to do, return the cash to your shareholders. Tell them to invest in that other company. They will diversify the risk themselves. You don't have to do their job for them. A second reason that companies use as a reason for a merger or acquisition is that the other company is undervalued. The target company is undervalued, so we are going to buy it. Well, if the target company is undervalued, you don't go and buy the target company. If you have so much cash, you return the money to your shareholder. Tell the shareholder to invest in the target company. That's a separate matter. Let him invest in that undervalued company. You don't try to do the shareholder's job for him. So those kind of reasons may not be very, very applicable for a merger or acquisition. But now let's look at why mergers or acquisitions fail. 2 major reasons. Number 1, you don't manage the post-integration period properly. You do the merger, but you haven't thought through about the culture of the company, the culture of the acquiree, the working conditions of the acquiree, and you try to impose your will on the acquiree. And as a result, there's a lot of friction, a lot of conflict generated during this post-acquisition period, and as a result your post-acquisition management collapses, and as a result your company doesn't do well. A second major reason for mergers and acquisitions to fail is that most of the time companies end up overpaying for the acquiree. Now shareholders have this belief that if a company acquires another company, they end up paying too much to buy that other company. That's why as soon as an acquisition announcement is made, you will find the acquirer's share price falling, the acquiree's share price rising. Facebook dropped, Microsoft dropped, Nokia rose, right? Now if you look at, imagine you're an acquiree and somebody has made an acquisition offer for you, you don't want to go ahead with this acquisition. There are certain defenses you can have to prevent your company from being acquired, and these defenses can be clubbed into two major areas. Number one is called a pre-bid defense, number two is called a post-bid defense. Now what's a pre-bid defense? In a pre-bid defense, what you're doing is, before an acquisition offer is made, you do certain things to prevent some such offers from being made in the first place. For example, you maintain high book values of your assets. In other words, you continuously revalue your assets so that you have a big asset base, and as a result nobody wants to acquire you, you're too large. Number two, you maintain good relationships with your shareholders. You continuously communicate with your shareholders so that if an acquisition offer is made, you can immediately tell your shareholders, please don't accept the offer. Believe in me, trust in me, I'm going to take this company forward. And then there are things like convertible bonds, which are called poison pills that you can have in your company. There are things called shark repellents, where you say 75% of shareholders have to approve an acquisition for that acquisition to take place. So those kind of shark repellents prevent an acquisition as well. Now after an acquisition has taken place, now let's say, or rather after an acquisition offer has been made, post-bid, now pre-bid defenses are over, somebody has actually made an offer for you, post-bid. In the post-bid approach, or if there is an offer made for you, there are some defenses you can take. Number one, you can write a rejection letter. You can tell the party, look, we are not interested in being acquired. Number two, you can advertise the prospects of your company on the papers and say, look, we are a fantastic company, we have so much potential, this company is undervaluing our assets, don't accept their acquisition offer. And number three, worst comes to worst, if nothing really seems to be happening, and if you think that this merger or this acquisition is going to create a monopoly situation in the market, you can go to the competition authorities and tell them, look, there's a guy who's trying to acquire me, don't let it happen, because if it happens, it's going to create an antitrust, anti-competitive environment. Fine. The last area that you all need to remember with regard to mergers and acquisitions is how you pay for a merger or an acquisition. And there are three main methods you can pay for an acquisition. Number one, you can pay in cash. That's what Microsoft did. $7.2 billion of cash paid to acquire Nokia. Number two, you can pay in shares. In other words, you can offer your shares to the target company's shareholders. That's called a share-based acquisition or a paper-based acquisition. The third thing that you can do in terms of an acquisition is to do something called a earn-out arrangement. And what is an earn-out arrangement? In an earn-out arrangement, it's very simple actually. What you say is, you tell the target company's shareholders, look, I'll pay $1 billion to buy your company. Out of the $1 billion that I pay, 50% I'll pay upfront. When I'm buying your company, I'll pay $500 million, I'll buy it. The other $500 million is conditional to certain terms being met. What are those terms? See, when I wanted to acquire you, you told me that there are certain profits you can make in the future, there are certain revenues you will make in the future, there are certain products you will launch in the future. Fine, I agree with you, I believe you. But it's only if you manage to hit those profit targets that you promised, it's only if you manage to hit those revenue targets that you promised, that I'll pay the remaining $500 million to you. And that is called a earn-out arrangement. So, quick summary with regard to mergers and acquisitions. Firstly, remember what are the reasons for mergers and acquisitions: economies of scale, synergies, removing competition from the market, etc. Remember that diversification and the fact that the target company is undervalued is not really good reasons for mergers and acquisitions. Remember why mergers and acquisitions fail sometimes and the reasons for failures. Remember how you can have a defense against a merger or an acquisition, pre-bid as well as post-bid. And finally, revise on how you can pay for a merger or an acquisition, whether you can pay it in cash, whether you can pay it in shares, or whether you can have a earn-out arrangement where you pay 50% cash upfront, the 50% cash after certain financial targets are met. So with that, we wrap up the area on mergers and acquisitions, and after we come back from the break, we'll be looking at valuation, the last major area in your syllabus. Hello and welcome back to the financial strategy revision. So we've covered 8 of the 9 key areas in your syllabus, so there's only one more area to cover, right, and that is valuation. Last but not least, I emphasize on that because valuation is a major area in your syllabus. It should not be taken lightly. Now in terms of valuation and how you value a company, there are pretty much 4 main valuation approaches that we can use. And what are those 4 main valuation approaches? One is called a net asset based valuation. One is called a dividend based valuation. One is called the earnings based valuation. One is called a cash flow based valuation. So let's look at each of these 4 valuation areas separately and identify how you could value a company using each of these 4 valuation techniques and where each valuation technique is relevant. Let's start off with net asset based valuation. This, to be honest, is the most basic form of valuation. Why? In net asset based valuation, it's very straightforward. And when a company wants to acquire another company, what are they acquiring? They are acquiring the equity of that company. Yeah, you want to acquire another company, you are taking over the share capital. Now this equity value already is there in your balance sheet. You have a book value of equity on your balance sheet. That's your net assets. Take your book value of equity, use that as one of your valuation approaches. Now here, couple of additional points to note. See, book value might not actually represent the future earnings potential of the company. Yeah, book value looks at past profits, not the future earnings. And when you are investing, you are not accessing past profits. You are taking an opportunity to obtain future profits. So that aspect is not brought in when you look at a net asset based valuation. Another point to note is, see, I told you that book value of assets, book value of equity is what you look at. If you want to take it one step further, you can look at instead of looking at book value of assets, you can look at the market value of assets, the net realizable value of assets. Yeah, because net realizable value is a more relevant valuation method of assets than the book value. So you can take the net realizable value of your assets, the net realizable value of liabilities, assets minus liabilities, that's the net realizable value of your equity. Or you can look at the replacement cost of your assets, replacement cost of your assets, replacement cost of your liabilities, deduct the two, you've got your replacement cost of your equity. Now one other major disadvantage of net asset based valuation is that net asset based valuation does not take intangible assets into account. Take a company like WhatsApp. Facebook valued it at $19 billion. WhatsApp has only 55 employees. Yeah, WhatsApp is a company, if you took their assets and you added their land and their property, their value probably is less than $1 billion. So how did Facebook value it at 19 billion? Because WhatsApp's value comes from its employees, WhatsApp's value comes from its software, WhatsApp's value comes from its patents. So these kind of assets are not valued under the net asset valuation method, and that's a major disadvantage, especially for IT firms, where the intangible assets are what generate the value, not the tangible assets. So that's why there's an approach called calculated intangible value in your syllabus, which you have to know in order to calculate the intangible value of assets. And once you know the intangible value, add it to the tangible assets, then you have the total value of your net assets. Now Also remember that net asset value can be used to place a flow value on a business, because whatever said and done, a shareholder is normally, in normal sense, not going to accept an offer that is even below the book value of equity. So normally you can think flow value, the minimum I have to offer to buy this company is the book value of assets. Next is your dividend based valuation. Now dividend based valuation is important if you are valuing a minority shareholding. So in a minority shareholding, right, you get a dividend, and that dividend is your return. So it's useful to value a minority shareholding. Again, when you talk about the dividend valuation model, it's the same as that cost of equity dividend valuation model. It's the same thing, except that we are rearranging the formula. In the cost of equity, we made cost of equity the subject. Here we are making the price the subject, bringing cost of equity to the bottom. So again, using constant dividends or constant dividend growth, you can calculate the dividend based valuation. Now the third major method of doing a valuation is something called earnings based valuation. Now in an earnings based valuation, what you do is you have the price earnings ratio of a company, and you take that price earnings ratio multiplied by the earnings of the company to generate the market valuation of equity. And the interesting thing about earnings based valuation is it's normally applicable for listed companies, because only listed companies have price to earnings ratios in the first place. But how can you implement a earnings based valuation to an unlisted company? You can do something called a proxy PE valuation, where you identify the price earnings of a similar listed company, apply that price earnings ratio to this unlisted company, and as a result you generate the earnings based valuation for this unlisted company as well. But one small nitty-gritty to remember with earnings based valuation is that it's a flexible approach. Why? You can put multiple PEs, you can take a forward PE, a trailing PE, you can take multiple levels of earnings, you can take last year's earnings multiplied by the PE, last 5-year average earnings multiplied by the PE, you can take this year's earnings multiplied by the PE, next 5 years earnings multiplied by the PE. So there are multiple ways in which you can generate an earnings based valuation, which is its strength, but which is also its weakness, because since there is no clear cut method of doing an earnings based valuation, there comes a question as to what earnings based valuation is the appropriate valuation for a company. Yeah, some person might say, no, we have to take this year's earnings multiplied by this year's PE, that's the value of the company. Some person might say, no, this year was a depressed year, let's take last 5 years earnings multiplied by the PE, that's the value of the company. Some person might say, don't look at historics, look at the future, take the next 3 years earnings multiplied by the PE. So that is one aspect of earnings based valuation that you need to be mindful of. It's not a disadvantage, but it's something to be mindful of in the earnings based valuation. Finally, we come to our last valuation approach, which is cash flow based valuation. Now in a cash flow based valuation, there's an important concept that you have to know, which is about free cash flows. What are free cash flows? Free cash flows are considered to be cash flows available for distribution to investors after all ongoing investments in current and non-current assets have been made, right? So normally free cash flow in very simple terms is the cash available for distribution to shareholders. It's from your free cash flow that you have to decide how much am I paying as dividends, how much am I going to retain within the business. So remember, it's your free cash flow that you will have to consider for a cash flow based valuation, because that's the money that will be available for an investor in the company. So in a cash flow based valuation, what do? You look at the future cash flows of this company. You discount those future cash flows to today and bring it to today's terms, and you see what is the value today of all the future cash flows that this company is going to be generating. That's the maximum value I'm going to pay to buy this business. If I pay a cent more than that, I'm going to incur a loss. Now, two methods you can do the cash flow based valuation. You can take your cash flows before deducting interest. You can take those free cash flows before deducting interest, discount at the WACC. The answer you guessed is the value of the company. From this value of the company, you have to deduct the value of debt to come up with the value of equity. The second major approach that you can use is you can take the free cash flows after deducting interest. That answer you discount at the cost of equity. That answer you get is the value of equity. You don't have to do any more deductions or additions. That is the value of equity of this company, right? So in summary, there are 4 major valuation techniques. Out of the 4 valuation techniques, net asset based valuation is the easiest. Dividend based valuation is very straightforward. It's just a rearrangement of the cost of equity formula. Earnings based valuation is very straightforward, PE into your earnings. Cash flow based valuation is very straightforward as well. It's almost like an NPV. Take your future cash flows, bring it to today's terms, that's the value. So we'll wrap up with this for this part of it, and I have now covered all areas in the financial strategy syllabus. After the break, let's look at how to approach the exam and how to approach the paper. Hello and welcome back to the final session with regard to this financial strategy revision. Now before I start off on this session, please remember, if you look at the slide over here, there are 9 major areas of financial strategy. You need to be confident in each of those major areas, right? Again, quick recap. Remember about introduction to financial strategy, in that you covered the dividend decisions, the advantages of a share repurchase versus a one-off dividend, those kind of things. Performance measures in financial strategy is about ratio analysis, yeah, and how you look at ratio analysis for a question. Short-term finance, remember about permanent current assets, fluctuating current assets. Remember about aggressive financing, moderate financing and conservative financing. Long-term finance, remember you can fund it using equity, you can fund it using debt. Equity can be done by an IPO, a placement, or once you've done an IPO, rights issue. Cost of debt or debt financing can be a borrow and purchase, it can be a finance lease, it can be a operating lease. Look at cost of capital. Remember, cost of capital is a combination of cost of equity, cost of debt and cost of preference shares. Capital structure, remember that treasury is the organization that deals with capital structure. Also remember that with regard to capital structure, there are 3 major theories: the traditional theory, Modigliani and Miller theory without tax, Modigliani and Miller theory with tax. Investment appraisal, remember about basic investment appraisal techniques like payback, discounted payback, whatnot. Look at the advanced investment appraisal techniques like adjusted present value, capital rationing, factoring in risk, etc. And look at foreign investment appraisal and how to do a foreign investment appraisal. Mergers and acquisitions, remember why people do mergers and acquisitions, remember why mergers and acquisitions fail, remember how to pay for mergers and acquisitions, cash, shares, earn-out arrangements, etc. Valuation, remember there are 4 major valuation techniques. There is a net asset based, there is a earnings based, there is a dividends based, and there is a cash flow based. So once you've grasped this amount of knowledge, you are good to go, you are good to face the exam. But in terms of facing the exam specifically, couple of quick pointers for you, right? You all are experts now, you all have faced so many Cima exams. This is nothing new for you and I'm sure you're going to do extremely well. But nevertheless, couple of quick pointers to refresh your memory, so to say. First of all, remember it's very important that you plan out your answer. I've had so many students who came back to me and said, I should have had an answer plan. Why? Especially be careful of areas you're confident with. Some areas you're so confident, as soon as you see the paper, you start writing like crazy. Halfway through your writing, you realize, oh no, I should have mentioned this point. You go back and start writing again. Then you realize, no, I should remove this point. You remove it, start writing again. You look at the paper, it's cut, chopped, inserted, small arrows inserted, the paper looks an absolute mess. Don't do that. Remember, if you fail to plan, you plan to fail. So always remember, have an answer plan, right? Plan out your answer. If your answer is for a question is for a 10 marker, imagine you have 18 minutes. From that 18 minutes, even if you plan for 9 minutes, that's fine. Because having a good plan, the remaining 9 minutes, you can write your answer in a solid manner. No, so remember, you don't need a detailed answer plan. You don't have to write an answer plan in your writing book. No. On your question paper itself, use a pencil, scribble down a basic answer plan. Use that plan to flesh out your actual answer. right? Also remember that when you are planning out the answer, remember to prioritize your points. So you are saying it's a 10 marker, I am going to mention 5 bullet points. Write the 5 bullet points in basic form on your question paper. Now decide out of the 5 bullet points, what is the point I am going to mention first. Because remember, a good first impression is very important. The examiner is looking at your paper maybe after marking 50 other papers. So he is tired, you need to give him a good first impression that you are a student who should pass. So always prioritize your answer so that the best bullet points come first, the not so good bullet points come right at the end. Stick to a time plan, right? So many students who fail at strategic level and top Cima especially fail because they fail to manage time. Time manages them, they don't manage time. So you have to make sure that you stick to your time. And one thing I recommend to students is, people say 180 minutes for a 100 mark paper, that means 1.8 minutes per mark. No, I recommend you go for a 1.5 minute per mark situation. So if it's a 10 marker, look at 15 minutes maximum. Why? Then even if you go a little over time, you are not using the time of another question. Why? You anyway allocated 18 minutes, you are using 15, even if you go to 16, 17, 18, you have run over time compared to what you planned, but you are still using the allotted time for your question. So go on a 1.5 minutes per mark scenario. Continuously check your watch to ensure that you are on target. Now, another important point to note is that you need to make your answer reader friendly. Don't have massive paragraphs. Don't have 8, 9, 10, 12 lines in a paragraph. The examiner may miss an important point in between when he is browsing through the paragraph. Have short paragraphs, 5 lines, 6 lines at the very most. Leave a line between paragraphs. Have a bullet point and paragraph format so the examiner can read the bullet point, understand the gist of your answer. If he wants to read further, he can read that short paragraph that you have as well, right? And most critically, you need to stop stressing out, right? Don't worry, you have got through 3 stages in Cima, right? This may be the second time you are attempting strategic, or but that doesn't matter, right? Go with a level head. Sometimes the level head is the difference between a pass and a fail, right? So also remember that if possible, do a few papers, minimum do a few papers before you go for the exam, because especially with regard to time management, it's only when you do papers, it's only when you time yourself and actually do it that you know whether you can manage your time or not. So quickly to tell you how I would recommend that you manage time. During your reading time, I would recommend personally, but remember this is up to students, you can decide what you want to do, but personally I would recommend you to look at deciding on what question in question 2 that you are going to pick, right? Because part B that you are going to pick, right? Decide on the 2 questions out of the 3 in part B that you are going to pick during the first 10 minutes of reading time. Next 10 minutes you start planning for that first answer in part B, the first question that you are going to attempt in part B. The reason I like students to start with part B first is that if you start with part B first, it's the only area where you have a choice. Out of 3, you can do 2, you can ignore 1. So there's a good...
Good evening, ladies and gentlemen. I'm Zahid Musafir and welcome to your Cima Revision program for performance strategy for the November 2014 exams. For over the next 45 minutes, I hope to increase your chances of passing the performance strategy exam drastically. How am I going to achieve this task? Well, what I'm planning on doing is, instead of looking at a very broad area in a little detail, I've decided that the best way to go forward is to take a specific area of your syllabus and go into detail, right? So, what is this specific area of your syllabus I've selected? I've selected your foreign exchange risk management, which is going to be the topic of this revision program. Now, why have I selected foreign exchange risk management? I've selected it for 2 reasons. The first reason being, this is probably one of the least understood and most unpopular areas of the Cima syllabus, more specifically the performance strategy syllabus. The second reason being, it's almost all the time tested. I'll give you an example. If you were to look at the immediate 4 past papers, your November 2013, March 14, May 14 and September 14, in each of these papers there are at least 25 marks on offer for foreign exchange risk management. So I feel that it is critical that you study this area, that you target this area, and that you get the maximum marks possible from this area. What is the strategy I would adopt? Look, you need 50 marks to pass the exam. If you can get at least 20 marks out of the 25 marks available for your forex risk management, you only need another 30 marks out of 75 marks, which should be relatively easy to get. Okay? So, let me outline, or let me give you a guide, or let me guide you through what we are going to do over the next 90 minutes. I will initially introduce you to your forex risk. I will then introduce you to the types of forex risk, how you manage this forex risk. We'll talk about your internal hedging techniques, we'll talk about your external hedging techniques, and finally we will look at how you can forecast your exchange rates. And if we have time, we'll also look at a few examination tips. I'm sure all of you all are familiar with the concept of risk. Yeah? People would define risk as the chance of something going wrong, or not achieving your desired objective or outcome. Or some people would simply say risk is not knowing what is going to happen. That's more in line with uncertainty. But anyway, in the context of forex, what is the risk you face? The risk you face is simply when you deal with transactions denominated in foreign currencies, the local value currency or the local value of these transactions could change depending on how your exchange rates move. I'll give you an example. If you are an importer, if you are importing a car from Japan today, if 1 yen is equal to 1.3 rupees, you are worried that on the date of settlement, 1 yen might be equal to 1.6 rupees, which would increase your cost by 30 cents per every 1 yen you are paying for your car. Right? Very basic definition of your forex risk. Moving on to the different types of forex risk, you have predominantly 3 types of forex risk. These are your transaction risk, your translation risk, and your economic risk. What is your transaction risk? What is the definition of your transaction risk? It is simply the risk of an adverse movement in exchange rates from the time of entering into a transaction and the time of settling your transaction. This movement could impact the total cost of your transaction in local currency. Let's look at an example. Let's say you are importing $10,000 worth of goods, payment due in 1 month's time. You enter into the transaction now and your payment due date is in 1 month's time. If the spot rate is $1 is equal to 100 rupees, if you had made payment today, your total cost would be rupees million. However, if the spot is $1 is equal to rupees 120 in 1 month's time, your total cost would be 1.2 million rupees. As a result of this movement in exchange rates, what has happened? You have to pay 200,000 rupees more. This is your transaction risk. This is the downside of your transaction risk. You could also have, a upside, right? What we refer to as your upside risk, where if $1 was equal to 80 rupees on the payment date, you'd only have to pay 800,000 rupees, which would result in a gain of how much? 200,000 rupees. Okay? So always remember, when you talk about risk, you have the upside and you have the downside. Clear? Right. Now moving on to your translation risk. Your translation risk is simply the risk of an adverse movement in exchange rates impacting the value of your foreign currency assets and liabilities. I'll give you an example. Let's say a Sri Lankan company invests $1 million in the USA. On the date of investment, if the spot rate is $1 is equal to 100 rupees, the cost of this investment would be 100 million rupees, and that is the value at which this asset would be capitalized on your balance sheet. However, we move 1 year forward as at the date of reporting for the Sri Lankan company, and the exchange rate moves to $1 is equal to 90 rupees. When you convert this asset into rupees, what happens to the value of this asset? It goes down to 90 million rupees. The value of your asset has declined. It has declined by 10 million rupees. Your revaluation loss is 10 million rupees. Is this a significant risk? Well, you could argue, look, it's just an accounting loss. There is no outflow of cash here, so we don't need to worry about it that much, right? But if you wanted to manage this risk, what you could do is you could match your foreign currency assets and liabilities. I'll give you an example. If you have a dollar asset of $1 million, on the other side you create a dollar liability of $1 million. Now in this example, if you had a $1 million liability, fine. As a result of the exchange rate movement, you lose $10 million of the value of your asset. But on the other side, what happens? The value of your liability in LKR terms would also decline by 10 million rupees. So you have a decline in an asset and a decline in a liability, and as a result, the net impact would be nil. So you are happy. We now move on to your economic risk. Your economic risk is a bit different to your transaction risk and your translation risk. Your economic risk is about how long-term movements in exchange rates impact the competitiveness of a country's products and services. I'll give you an example. Let's take Toyota, a large Japanese automobile manufacturer, and we will assume that Toyota would price the latest model of the Toyota Corolla at 1 million yen every year. But for a Sri Lankan importing the Toyota Corolla, his cost in rupee terms would be based on how the exchange rate moves. And let's face it, as Sri Lankans, we will always be worried about what is our cost in rupee terms, because that's what goes out of our pocket. Now, as you can see, the yen has appreciated against the rupee, the yen has become stronger, and as a result, we have to pay more rupees for every yen we buy. So, the car price in rupee terms has increased from 1 million in 2010 to 2 million in 2012. What has happened? The Toyota Corolla car has become more expensive, right? And because it has become more expensive, fewer Sri Lankans would want to buy it. Due to this cost increase, this Japanese product has become less competitive, right? Less people want to buy it. Sri Lankans might then move to the Korean manufacturers, maybe because their currency has not appreciated to that extent. This is your economic risk. How are you going to hedge your economic risk? Are there any instruments available to hedge your economic risk? Given its long-term nature, economic risk, you don't have any instruments which you could use to hedge, but what you could do is you could enter into a process of geographical diversification. You could move your markets, you could move your production locations to different countries, right? A classic example would be Toyota having plants in the USA, in Thailand, in the UK to cater to those respective markets. If they have a plant in the UK, they are incurring costs in pounds, they are receiving revenues in pounds, and as a result, they are not exposed to currency risk there. Now we will move on to the main component of your syllabus. How are you going to hedge your transaction risk? When you talk about hedging transaction risk, you have two methods of hedging, or very two broad methods of hedging. These are your internal techniques and your external techniques. What you need to remember is when you are hedging these transactions, you need to first hedge using your internal techniques. And if and only if there is a further unhedged component, do you go to your external techniques. So I will repeat again. What you do is you first hedge using internal techniques and then you move on to your external techniques. Is that clear? Before we go into the individual hedging instruments, we need to look at what is the objective of hedging, right? You could use hedging instruments for various activities. You could enter into these hedging instruments for speculative purposes. That is, you try to make profits, you try to make arbitrage gains via speculation. But remember, the purpose of hedging is not to make profits. The purpose of hedging is to fix your cost. It is to remove the uncertainty associated with the movements in exchange rates. That is why we engage in the process of hedging. So that is something that you need to keep in mind. And now we will move on to the different methods of hedging available, the internal methods of hedging. So we have your first available option or first method, which is do nothing, a very interesting or rather very easy method to adopt. You could engage in matching, you could engage in netting, be it bilateral or multilateral. You could engage in leading or lagging, you could invoice in home currency, or you could engage in barter trade. We will look at these individual methods a bit later on. We then move on to your external hedging techniques. We have your forward contracts, which is the very basic external method. You have your money market hedging, you have your futures contracts, options, swaps and swaptions. Let's look at your internal hedging techniques. Let's look at the do nothing option, right? As I told you earlier, this is the easiest method to adopt. But what is the rationale behind this? The rationale behind this method is that in the long run, you will make forex gains, you will make forex losses, but if you were to sum these gains and losses, they would be cancelled out in the long run. But having said that, the main disadvantage of this method is that it leaves you exposed to sudden large fluctuations in exchange rates, which could cause significant losses and have an impact on the going concern of your organization. That is something you need to keep in mind before you adopt a do-nothing approach to managing your forex risk. Moving on to your matching. Matching is like this. Let's say you take XPLC as an example, who is both an importer and an exporter, and he exports goods for which he is to receive $10 million in 3 months' time. On the other side, what he does is he imports goods for which he has to pay $12 million in 5 months' time. Normally, what you would do is when you receive your money or when you receive your dollars in 3 months' time, you will convert them to rupees, spend them, and then when you need dollars in 5 months' time, you will go out onto the market and buy these dollars. But if you are using matching, what you would do is you would open yourself a foreign currency account. When you receive this $10 million, you will deposit these dollars, earn interest for a period of 2 months, and then use this $10 million to settle your payment due in 5 months' time. So as a result of engaging in this process of matching, your net exposure would only be $2 million, which if you wanted to, you could hedge using external hedging techniques. And now we move on to your leading and lagging. right? Again, let's take an example. Let's say you're an import of goods. You're importing $10,000 worth of goods, and when you enter into the transaction today, your spot rate is $1 is equal to 100 rupees. What you're worried about is what is the exchange rate going to be on the date of payment. We move forward 1 month, and the dollar-rupee exchange rate has moved up to 150 rupees, which, based on your experience as an importer, is a relatively high rate. Historically, it's probably one of the highest rates you have, and you feel that the dollar cannot go up any further, it will decline. So what do? You hold off payment. You wait until the dollar declines to a relatively more acceptable rate. Let's say you wait till it reduces to 110 rupees, which you identify is a fair price for the dollar, and you make your settlement at this point of time. That is what we refer to as your lagging, delaying payment until there is a reasonable or an acceptable exchange rate on the market. But what you need to remember is, if you are engaging in the process of lagging, you need to make sure that the benefit you receive from delayed payment should be greater than any fines or penalties your customer could levy on you for delayed payment. Only then would this business of lagging be worthwhile. Let's look at a different scenario. Again, you enter into the transaction when $1 is equal to 100 rupees and payment is due in 1 month's time. But halfway through, what happens is the dollar declines to $1 is equal to 90 rupees, which, based on your experience, you identify as an exceptionally low rate. You identify that the dollar cannot go any lower than this. So what do? You make payment. Why do you make payment? To benefit from this exceptionally low rate. However, again, if this is to be viable, you need to compare what is the benefit you get from your early settlement against the financing cost you will incur for making early payment. Remember, there is a working capital implication here. What is the working capital implication? You only need to make payment in 1 month's time, but if you make payment earlier, you will need to finance that early payment. So you need to compare those two costs. We will now move on to what we refer to as your bilateral netting. How does bilateral netting work? Bilateral netting is basically where you have X Limited, which is in Sri Lanka, and you have Y Limited, which is in the USA. X sells $100 million worth of goods to Y. Y sells $70 million worth of goods to X. What do? Does X pay Y 100 million and then does Y pay X 100 million? No. They knock off these transactions and they say, look, why don't you just pay me, or rather X says, why don't I just pay you $30 million for this transaction instead of 100 million going up and 70 million going up and down. Relatively simple method of hedging, I am sure most of you all would agree. But this is only between two parties. Let's make this a bit more complicated. Let's bring in a few more parties. And then I introduce you to what we call multilateral netting, or netting among multiple parties. And as you can see, this example is a bit more complex. How do you deal with a multilateral netting question? Well, the first thing you need to identify, or rather, the steps you need to adopt in your multilateral netting is you first tabulate all transactions, then you convert all transactions to a base currency. This base currency will be given to you in your exam. You don't need to decide on your own. Read your question carefully. It would specify what is the base currency. Normally, this would be the home currency of the parent organization. Then what you will do is you will tabulate your payments vertically and your receipts horizontally. Then you would identify, or you will calculate your net payments or receipts, and then you can decide what is the pattern of payments that need to be made. Let's look at an example. Now, what I do is I tabulate the transactions which I showed you in the previous example. How does this work? How do you interpret this table? The horizontal axis, or if you look at this table horizontally, it indicates who is receiving money. If you look at this table vertically, it indicates who is making the payment. Let's look at the extreme right corner of your screen. You have E, and there is $25 million exactly below E. How does that work? Or how do you interpret this? You interpret this as E is making a payment of $25 million to A. So therefore E is making a payment which is on the other side a receipt for A. If you go down to the 500 million yen transaction, how will you interpret that? E is making a 500 million yen payment to C. So once you've tabulated these transactions, into a nice little table, you then convert these transactions into the base currency. How does that work? The first transaction, E paying A, you don't need to convert. Why? Because it's in dollars. The base currency in this question is dollars, right? And then similarly, all other transactions also you convert to dollars. And then what you do is, you total all transactions horizontally. Remember, when you read this table horizontally, it indicates all receipts which were made. So, if I look at the first row under total receipt column, what it indicates is what is the total amount of money in dollars A has received. If I go down further to 12.5, what is the total amount of money that B has received, and so on and so forth. Similarly, if you total, or if you look at the totals going down this table or vertically downwards, it indicates what are the total payments that were made. If you look at the far left column, it indicates of 12.5 million payment. What this indicates is how much of payments has A made during the period. So then what we do is we take your total receipts against your total payments and arrive at the net cash flow for each subsidiary. That's the very bottom column. How does this work? How do you interpret this? It shows that there is a net receipt of $12.5 million for A net receipt of 6.94 million for B, a net receipt of 5 million for C. There are no receipts or payments for D, whereas there is a net outflow of 24.4 million to E. If I were to total these positive cash flows, it should be equal to the total negative outflow from E. So how do we interpret this table? This table would be interpreted as E would make payments of $12.5 million to A, $6.94 million to B, and $5 million to C, resulting in a total outflow of $24.4 million for E. And we then move on to the next method of internal hedging techniques, which is invoicing in home currency. What is invoicing in home currency about? It's something we are very familiar as Sri Lankans. I'll give you an example. When you buy your vehicles from Japan, or when you buy machinery from the US, we are being invoiced in yen, we are being invoiced in dollars, which is the home currency of our suppliers. What are these guys doing? What they're essentially doing is they are transferring their foreign exchange risk to us. They are transferring the risk to their counterparties. It's a very effective method of hedging, but the only problem is, for you to adopt this sort of a hedging technique, you need to have a relatively strong bargaining strength or a relatively strong bargaining power for you to transfer this risk to your counterparty. And finally, we move on to your barter trade. How does barter trade work? It's basically exchanging goods for goods. You try to bypass the currency system altogether. I'll give you examples of barter trade in today's context. You have you had Iraq's oil for food program, which is a classic example of barter trade, but that was brought about due to restrictions or restrictions via the UN. Moving on to your external hedging techniques, we'll start off with a very basic product, your forward exchange contracts. What is a forward contract? It's simply a legally binding document, or a legally binding contract to buy or sell a fixed amount of currency at a fixed price on a fixed date. Let's look at an example of how it works. Again, you are importing $10,000 worth of goods, payment due in 1 month's time. So, we'll assume the spot is $1 is equal to 100 rupees today. Your total cost would be rupees 1 million if you were to settle today. But you're not making settlement today, you're making settlement in 1 month's time. What you are worried about is how much would the dollar be in 1 month's time. So what you do is you tell your friend, the banker, look, I have a problem like this, what do I do? And he tells you, look, don't worry about it, no problem. Why don't you enter into a contract with me where you agree to buy $10,000 at a price of $1 is equal to 110 rupees in 1 month's time. And then we wait. And in 1 month's time when payment is due, we could have two possibilities. One possibility is where $1 is equal to 120 rupees. The other possibility is where $1 is equal to 80 rupees. If we look at the first scenario where $1 is equal to 120 rupees, if you buy dollars using your forward contract, your total cost is 1.1 million rupees. Whereas if you were to buy dollars on the market, your total cost would be 1.2 million rupees. So from your perspective, you would be happy. Why? Because you could buy dollars at 1.1 million rupees total cost as opposed to 1.2 million rupees on the market. But let's look at a different scenario. Let's see what happens if $1 is equal to rupees 80. Your total cost based on the forward contract would be 1.1 million, but if you were to buy these dollars on the market, you could have bought them at 800,000 rupees. Therefore, you are losing out on how much? A 0.3 million rupee gain. This is the fundamental disadvantage of forward contracts. While they fix your cost, while they mitigate or manage the downside risk, they do not allow you to participate in the upside risk. So this is one of the fundamental disadvantages of forward contracts. Let's look at the advantages and disadvantages of forward contracts. What are the advantages? Like we discussed just now, they manage your downside risk. They are also readily available with most banks, and you could hedge any value. Why? Because these are over-the-counter products where you could create a perfect hedge. Even if you wanted to hedge $975,262,000, you could enter into a contract for that exact value. What are the disadvantages? Like we discussed earlier, you cannot participate in the upside. They are only available for major trading currencies. If you wanted to, let's say, enter into a forward contract for rupees, if you are in a foreign country, you might not be able to do that because the LKR is not a major trading currency. And finally, forward contracts are only a relatively short-term method of hedging. In Sri Lanka, the maximum period you could enter into a forward contract would be somewhere around 6 months. When Sri Lanka was experiencing extreme exchange rate volatility, the central bank only allowed you to enter into forward contracts for 2 weeks. So the point I'm driving at is you can't hedge your long-term forex risk using forward contracts. We now move on to your currency options. What is your currency option? It's very similar to your forward contract, but here you have a right and not an obligation. I will give you the exact definition of a currency option. A currency option is the right and not the obligation to buy or sell a fixed amount of currency at a fixed rate on or before a given date. So, let's look at an example again. How does it work? Same scenario, you are worried about your total cost increasing as a result of an adverse movement in exchange rates. So you fix your price at $1 is equal to 110 rupees, and you have two possibilities. Like earlier, the dollar goes up to 120, or the dollar goes up to dollar goes down rather to 80. If the dollar goes up to 120, if you exercise your options, your total LKR cost would be 1.1 million. Whereas if you were to purchase these dollars on the market, your total cost would be 1.2 million rupees. So therefore, it makes more sense for you to exercise your option and you are a happy person. However, let's look at the flip side. Let's look at what happens if $1 goes down to 80 rupees, or rather if the dollar goes down to 80 rupees. In the previous example, you are compelled to buy at 110 rupees per dollar, which is the price you fixed. However, in an option, you don't have an obligation. It's your choice. So if it's more beneficial for you to purchase these dollars on the open market, you'd say, look, no thank you, I don't want to buy dollars using the option, or I don't want to exercise my option, I will buy on the market. And therefore, using options, you have the ability to participate in the upside as well. But what you need to remember is, this added flexibility comes at a cost. It comes at a significant premium. If you were to compare the cost of options versus other hedging instruments, options would definitely be the most expensive. Before we move on from options, let's look at the different types of options which are available. You have your call options and you have your put options. A call option is an option which gives you the right to buy, whereas a put option is an option which gives you the right to sell. We'll then look at your European options and American options. The fundamental difference between European options and American options is that European options can only be exercised on the date of expiry, whereas American options can be exercised on any day up to the date of expiry. Again, your American options would give you added flexibility when compared to your European options. And now we will move on to your next method of hedging, your money market hedging. How does money market hedging work? Well, it's like this. Let's say, for example, you need to make a payment in 1 month's time, a payment of $10,000. What you are worried about is, in 1 month's time, how will the rupee dollar exchange rate move, and will I have to make or will I incur a larger rupee cost in 1 month's time? So what do? You buy dollars now, right, and use those dollars to pay off your transaction in 1 month's time. So you simply don't buy the dollars now. What you do is, you buy, let's say if you are hedging $10,000, you buy a lower amount of dollars and you deposit those dollars in a dollar account, allow that dollar account to accrue interest, right, and then at the date of payment, you use that dollar deposit to settle off your dollar liability. If you look at money market hedging, let's look at an example. You have X Limited based in the USA who is importing 10,000 pounds or rather 100,000 pounds worth of goods with payment due in 3 months time, and they've given you some information here. They've given you the 3-month pound dollars forward rate, they've given you the spot rate for the pound and the dollar, and they've given you deposit rate and lending rates in the UK and the USA. Let's look at how we hedge a payment. Now remember, when you are hedging a payment or when you are hedging this particular transaction, you need to make a payment of 100,000 pounds in 3 months time. So you have a pound liability. What have we got to do? We need to create a corresponding asset. We need to create an asset which would be equal to 100,000 pounds in 3 months time. So what we do is, we need to place a pound deposit. How much of a pound deposit do we place? Is it less than 100,000 pounds or more than 100,000 pounds? Remember, you need to deposit less than 100,000 pounds. Why? Because over the 3-month period, your deposit will accrue interest, right? So you need to first establish what is the value of the pound deposit I make now. So how do we do this? We take 100,000 pounds divided by 1 plus the respective pound deposit rate. And you divide that pound deposit rate by 4. Why? Because that pound deposit rate given in the question was an annual rate, whereas you are only depositing for 3 months. And we established that you need to deposit 99,000 pounds today, or rather 99,009.9 pounds, thousand pounds today, if you are to have 100,000 pounds in your bank account in 3 months' time. But we don't have pounds in our hand. Why? Because we are in the US, we have dollars. So what have we got to do? We need to purchase these pounds on the market at the spot rate. Why? Because we are buying these dollars now. And as a result, the dollar cost of this transaction would be $108,910.89. But for the purpose of comparison, we assume that these dollars are borrowed for a period of 3 months. So, assuming they were borrowed, the total dollar cost of this transaction would be $108,910.89 multiplied by 1 plus 7.5% divided by 4. What is this 7.5%? It is your dollar lending rate, but again, you're not borrowing for 1 year, you're borrowing for 3 months, or rather you're borrowing for 3 months, so therefore you divide by 4, and this gives you the total dollar cost of this transaction of $110,952.97. Now wait a minute, let's look at what has happened here. After a period of 3 months, that pound deposit you placed of 99,009.09 pounds is now equal to how much? 100,000 pounds. In 3 months' time, you need to settle your supplier how much? 100,000 pounds. So what do? You uplift that pound deposit and you pay off your supplier. Are you exposed to any exchange rate risk? No. Why? Because you are in the US, true, but you have pounds to settle your pound liability. You have pounds to settle the pound payment due to the supplier. Right? So that transaction gets knocked off there. But on the other side, what has happened? The total dollar cost of this transaction is $110,952.97, and remember, this dollar cost will not change no matter what happens to the exchange rate, right? No matter what happens to the exchange rate, your dollar cost is going to be 110,952.97, and therefore what you have essentially done here is you have eliminated your exchange rate risk by entering into a money market hedge. What you have done is you have fixed the dollar cost of this transaction. That is how your money market hedging works. This is how you will hedge a payment. Let's look at how you hedge a receipt, right? I'll skip this slide and I'll move on to the workings of it. Yeah, let's take an example again. X Limited, based in the USA, is exporting 100,000 pounds worth of goods with payment due in 3 months' time. 3-month forward rate is given, spot rate is given, they've given you the deposit rate and the lending rate in the US and the UK. How do we hedge this transaction? What is happening here? In 3 months' time, someone is going to give you 100,000 pounds. Have you got an asset or a liability? You have a receivable, therefore it is an asset. So previously, when you hedged payment, what we did was we had a liability. So what did we do to hedge that transaction? We created an asset. What will you do here? You have an asset, therefore what you do is you create a liability. When you are hedging a receipt, what you would do is you would create a liability which would be equivalent to that foreign currency receipt on a future date. So what have we got to figure out? Okay, how much is the loan I should take now which would be equal to £100,000 in 3 months' time? Will I borrow £100,000, less than £100,000 or more than £100,000? I would borrow less. Why? Over a period of 3 months, what would happen? The loan would accrue interest. Okay? So as a result of the loan accruing interest, the value of the liability would increase. So I would borrow a value less than £100,000. How do we calculate this value? £100,000 divided by 1 plus 6%, which is the pound lending rate, divided by 4. Why do I divide by 4? For the simple reason that I am borrowing only for 3 months, and that would give me a value of £98,522. This is how much I should borrow now. I take this loan, I get these funds, but I am in the USA. Have I got any use having pounds? No. So what do I do? And also, if I keep these pounds with me, what happens? I am exposed to an exchange rate risk. So what I do is, as soon as I get these loan proceeds, I convert them to dollars at the spot rate, which gives me a value of $108,374. But remember, these are excess funds. So what do? I deposit them. I deposit them for how long? For a period of 3 months. And how do I calculate the total deposit value at the end of 3 months? It is simply 180,374 multiplied by, inside brackets, 1 plus 5%. What is 5%? That is your dollar deposit rate divided by 4. Why am I dividing by 4? I am only depositing for 3 months, whereas this interest rate quoted here is an annual or per annum interest rate, which gives me a total value of $109,729. Now what happens? Can we look at the series of transactions, or what happens in 3 months' time? In 3 months' time, my supplier pays me £100,000. Okay? But on the other side, I have taken a bank loan, which also in 3 months' time is equal to how much? £100,000. So what do? I settle that loan with I settle the pound loan with the pound proceeds. That transaction gets knocked off. What am I left with? I am only left with the dollar deposit I created, which is worth how much now? $109,729. As a result of me entering into these transactions, what have I done? I have fixed the dollar receipt of this pound inflow. No matter what happens to the exchange rate, I will always get $109,729, and thereby I have hedged this transaction. That's how your money market hedging works.